Hey everyone! Next week, the Federal Reserve is expected to raise the overnight rate by another 25 basis points, taking the federal funds rate to the 5.25% to 5.5% range. Wall Street has pretty much already baked that increase in because Chairman Powell very clearly telegraphed that move at the press conference after their last meeting. And as everyone is very well aware, the Fed's doing this to reduce inflation. But they're trying to do it without pushing the economy into a recession. So far, it looks like they're doing a pretty good job, but we're not at the finish line yet. The headline inflation rate has fallen from 9.1% last year in June to just 3%. And the producer price index is down even more, from 11.6% in March 2022 to less than 1% in June this year. Even core PCE, the Fed's favored measurement, has made progress. It runs a month behind the other numbers, but it was 4.6% in May. Slow but steady progress toward the Fed target of 2%, but there's still a ways to go. On the other side of the equation is the economy. Will the Fed be able to achieve a soft landing? We're definitely seeing a loss of economic momentum. Job creation is steadily slowing. In the first half of 2021, the US added 3.3 million jobs. In the first half of 22, about 2.7 million jobs were created. And in the first half of 2023, we were down to about 1.7 million new jobs. That's still very strong. For perspective, between 2010 and 2019, the US added an average of about 1.2 million jobs in the first half of each year. But if you look at the trailing 3-month average job creation trend, you can definitely see a loss of momentum. We're roughly back in alignment with where we were between 2014 and 2017. The trend's also apparent when you look at the seasonally adjusted personal consumption for the first 5 months of each year. In 2021, consumption in the first 5 months of the year grew by an average of 1.2% per month. Then in 2022, it was down to 0.5% per month. And in 2023, the average growth rate through May has been just 0.2% per month. It's a similar story for core retail sales, 1.6% average monthly growth in the first 5 months of 2021, then 0.6% growth in 2022, and in the first 5 months of 2023, core retail sales are basically flat. So the Federal Reserve's effort to slow the economy is working. Job creation is slowing down, and so is spending. But we're coming to the point where things will become a little tricky. Using interest rates to steer the economy is kind of like steering a giant cargo ship. After you start turning the wheel, it takes a while for the ship to actually turn. And if you turn the wheel too much, the cargo ship will overcorrect, forcing you to spin the wheel the other direction. The Fed started turning the wheel last year. And in the third and fourth quarter, they were spinning the wheel pretty fast, locking in 4 75 basis point rate increases. And we're just now starting to see the arc of the ship turning. What we don't know yet is whether they oversteered. We probably won't know the answer to that question until sometime around the fourth quarter. If they turn the wheel too much, we'll dip into a recession. But again, so far it looks like they're in the right range. If there is a recession looming, it would likely be very mild. The economy, especially the jobs market, has proven to be very durable and resilient. One potential cross-current that could disrupt the trajectory, though, is the reinstatement of student loan payments. Deutsche Bank estimates that when student loan payments start back up, they could reduce consumer spending by about $14 billion per month. That's a reduction of about 3%. So there are some economic risks beyond just the interest rates that could show up in the second half of the year. Still, from the way things look right now, a relatively soft landing is looking increasingly probable, and that's a good thing for commercial real estate. We're seeing revived apartment demand with close to 100,000 units absorbed so far this year. Retail also looks like it's performing well. We're still finalizing our second quarter numbers, but preliminary estimates show vacancy is pretty much flat for the first half of the year, about on par with pre-pandemic levels. So in net, the economy is slowing, but a soft landing looks like a real possibility. Structurally, most property types in most markets remain on sound footing. So if rates stabilize and we achieve a soft landing, the underlying demand drivers should reassert, supporting commercial real estate fundamentals. That, of course, will reinforce the longer-term commercial real estate drivers and allow investors to once again focus their eyes on the horizon.